Let me give you three common mistakes. One would be hiding in cash. Yeah, cash feels safe because the balance doesn't bounce around very much. But if inflation runs at 3 or 4% or higher and your cash earns less than that after taxes, your purchasing power is going backward each and every year, quietly, politely, but relentlessly. Second is relying too heavily on fixed income that doesn't give you enough growth. Now, a bond ladder or a fixed annuity may have a role in your plan. But if too much of your income is fixed while your costs keep rising, you may be locking in a standard of living that gets worse over time. Then third is using a rigid withdrawal strategy. If you insist on pulling the same amount from a portfolio, no matter what inflation and markets are doing, you put more pressure on the portfolio during exactly the wrong periods. Being a little bit more flexible can help alleviate some of the effects of both inflation and poor markets. So inflation is not just a line item, it's a stress multiplier. Now, this is why retirees usually, I'm going to stress usually, still need some stock exposure. Not because stocks are fun and not because volatility is somehow good for your soul, but because owning productive businesses has historically been one of the better ways to keep up with inflation over long periods of time. If your retirement might last 25 or 30 years, you need at least part of your portfolio growing faster than the cost of living. Now, that said, and this is important, inflation is not just an argument for being reckless. Too much stock exposure at the wrong time creates different problems, especially if you retire into a bad market and you're simultaneously dealing with high inflation and large withdrawals. In that case, you just might get hit from both sides. That's why the answer is not forget inflation, go 100% conservative. But the answer also is not inflation is scary, therefore go 100% aggressive. The answer, as it usually is balance. Enough growth to defend purchasing power and enough stability that a bad sequence of returns doesn't wreck the plan. Now, let's use a simple example. Let's say a couple retires at 65 with $2 million invested and needs $80,000 from the portfolio in year one, on top of Social Security. That's a 4% starting withdrawal rate. Now assume inflation averages 3%. If they blindly increase that $80,000 with inflation every year, that withdrawal becomes about $92,700 in 5 years, or about $107,500 in 10 years, and roughly $145,000 in 20 years. Same purchasing amount, much larger dollar amount. Now, imagine they tried to avoid all market risk by moving almost everything into cash and short-term instruments, earning, say, 2% after fees and taxes. Their spending need is rising at 3%. Their assets are compounding at 2%. That's not a recipe for confidence. That's a recipe for what we would call a slow squeeze. On the other hand, if they stay too aggressive and retire into a sharp bear market, inflation-adjusted withdrawals can magnify the pressure on that portfolio. So again, this is why retirement income planning is a design problem, not a slogan.